Me start? Are you sure I should start? All right, we're starting. Hey, Scott DiGregorio here with Edgardo Ballantyne, Primary Residential Mortgage, coming at you with some good information. What's up, bud?
Not much, man. No, a lot is up.
Yeah.
So we missed last week.
Yes.
And then...
But good reason. We were in Utah. Great training.
Yeah, we were in Utah for a corporate training. Mm-hmm. And we got a lot for you guys, man.
Yeah.
We last week was a big week for us.
Yeah.
It was a big week. So let me start with the program that we've been talking about for a while now.
Yeah.
So for a while now, we were talking about 101% financing that we were gonna launch. And then it's finally launched.
Yeah, there we go.
Finally have it here. So the way it works is it's going to be a loan where we're going to give you not only your down payment, but we're also going to give you up to 1% for your closing costs. Now, that's not going to cover all of the closing costs, of course, but even though we're giving you the 101% financing, you can still ask for closing cost assistance.
Of course, up to 3%.
Up to 3%.
And by the way, big picture, conventional loan, primary residence, right?
660 credit score.
660 credit score. You get a 97% first mortgage and a 4% second mortgage, same interest rate. So just big picture, that's how that works.
Yeah. Oh, and by the way, no mortgage insurance.
Oh, yeah. That little detail. Let's not forget that.
So I'm pretty happy about that. I think this is going to help out a lot of people.
And look, let me touch on the no mortgage insurance thing because everybody has what they call lender-paid mortgage insurance, and most of it sucks, and here's why. The rates suck. The rate is so...
awful.
I mean, and the rate's always going to be a little bit higher in a situation like that, but so often it's so much higher it makes no sense. In this case... you're looking at interest rates truly a quarter or a 0.5% above markets.
Right. And so, again, right now, I'm very happy to say that we have the ability to really help somebody to get into a house with very, very little money out of pocket and definitely with no down payment. We can do that with this program, which is amazing. Again, this is a conventional loan. We give you 4%, 3% to use for your down payment, the 1% for the closing costs with no mortgage insurance. And then we also have other alternatives for FHA financing with
more traditional down payment assistance. And by the way, on the conventional thing, I've been asked this a lot. Hey, Scott, which down payment assistance program is it? This is a proprietary thing that we're offering.
That's right.
So I can't say we're the only ones in America with it, but we're the only ones I know of in America with it.
There you go.
So
and obviously you can get a condo with this.
Yes.
So it's
2 to 4 family if you're going to live there.
That's right. So just very excited about that program, and now that it's out, I can't wait to start helping people. I have a couple people shopping for it, so it's
absolutely
exciting.
Yeah. So if you or somebody you know or whatnot is pretty well qualified. But the challenge is the down payment. Reach out to us, and this program
we have products for you.
Yeah, this program really can make a difference.
Okay, let me just run with this too. Last week was also very exciting because here at Primary, we're now able to qualify people that are under DACA. And that's really big, and not only really big, man, but that's so deserved. Like, these are kids that have been here for a long time, that this is their home. They can work here legally. They've been working, and then now we're telling them that they weren't able to buy a property.
Right.
Even though they do taxes and everything like that. Well, now we can.
Yeah.
It's very exciting. You can go with as little as 3% down, and, condos is fine.
This is a conventional loan also.
This is a conventional loan also, yeah. So anywhere from 3 to 5% down payment. And it's just very exciting, man, because I have a lot of people that I haven't been able to help, that I want to help, and otherwise are perfect loans. They deserve to get into the house, and now they're able to do it. So very, very excited about that.
Now, you probably understand I'm less excited about that because I am pretty sure I have had zero DACA problems in my 20-something years, but... it's great the program's available, and it's a big need that's being filled.
And look, it's something that happens all the time. It's something that unfortunately, when it comes to immigration status, whether it's because of lack of due diligence or simply ignorance, because they don't know exactly what to look for. There's a lot of people that get on their contract, they get qualified, they go to their bank, get on their contract, and late in the process they realize that because of their immigration status they can't qualify.
Exactly.
And there's nothing worse than that. So right now, one of the people that I have shopping on that particular loan is somebody that was ready to close next week and was declined because she's part of DACA.
Right.
Now, in her particular case, she didn't qualify for this particular loan because it was a little too much. But now she's back shopping for a loan that she can definitely qualify in.
Yeah.
So just very exciting.
It's big stuff. And by the way, I see some people watching. If people watching have any questions, just type them in and we'll address them. But well, crap. So I mean, we had exciting stuff on our end, and I know we have more to talk about. But let's talk about the Fed last week.
Yes,
dude.
big.
Fed comes in
came
big
in
last week. So.
Which they haven't for a while, man.
I know that.
It's
I know
nice for them to throw us a bone like that.
Exactly. And look, we've talked about it that starting in 2019, the Federal Reserve, at the end of every single meeting, they're going to have a press conference, which
is what brings volatility, and which is what makes the market move at the end of the day.
Absolutely. And we've had a lot of negative movement here happening for a while, but last week they come out and they say not only are we going to have 0 rate hikes for the rest of 2019,
right.
They're only predicting 1 for 2020. So look, check it out. Most people get this wrong. The Federal Reserve does not control mortgage rates, okay? But the Federal Reserve controls what's called the Fed funds rate, which affects other rates, not mortgages. But here's what the Fed does. The Fed talks about whether or not the economy's in good shape.
Right.
So why the Fed helped interest rates was not because of what they did or didn't raise. It's because they told everybody, look, the economy's not as strong as it's been. We're going to slow down the rate hikes. And this was what benefited the bond market.
It affects the market.
Right. So interest rates improved to the lowest level we've been at since over a year.
13 months.
13 months. So
13 months and counting.
And counting. Yeah. So this is exciting. There were people that either didn't qualify, the interest rate bumped them out of the market, that can now talk again. I'm doing more refi. I got a bunch of refi requests now.
And a lot of people that now can qualify for that little extra. And, we're in an area where houses, appreciate quite a bit.
Yeah.
And you can't really get into a house for very little money. So to be able to have that little bump, it's helpful.
It's super helpful. And then the other thing that the Fed said, this is big, and this could get a little technical, so I'm not going to get into the weeds with it, but the Fed has purchased a lot of bonds and treasury notes and things, and they have them on their portfolio, trillions and trillions and trillions of dollars worth.
Because that's the other way that the Fed will affect the rates.
That's the way the Fed affects mortgage rates.
That's the way the Fed affects mortgage rates.
Yeah.
Is by what they say about the economy, blah, 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 but more directly how they spend the money.
Exactly. So those of you watching probably remember quantitative easing. Quantitative easing was the government buying mortgage-backed security bonds to help push down rates. That's why rates were so low.
Right.
So now they own all of these mortgage-backed security bonds. Well, I mean, think back third grade economics, supply and demand, right? So now, if they're not buying, there's less demand. If they then start selling, there's less demand plus more supply, and that can really hurt interest rates. So not only was the mortgage bond market benefited by them saying the economy's not in perfect shape, additionally, they said we're not going to be selling a bunch of our inventory, which just really, really helps things. So put all that together, what do we have? We have the best rates we've had in 13 months. And
13 months, man.
It's big. Now, by the way, this could be gone an hour from now.
This could be gone as we speak.
Yes. So, don't call me next Wednesday if things change and yell at me. But as it stands right now, this second, as we're recording this, we're in a good place with rates.
Yes, that's right. That's just all good stuff. So if you're interested in refinancing, if you're interested in, and look, honestly, we really follow the bond market, and we follow, we see where it's at right now, and we also follow the different indicators that will show us where it's going to move.
100%.
So if there's anybody out there watching this that would like to learn a little bit more about how, why the rates are the rates.
Right.
That's something that we like to talk about.
Yeah, and we don't get into the weeds in this format because most people want to poke their eyeballs out with a fork.
Right.
If they hear about mortgage-backed security bond markets.
Where every once in a while.
Once in a while you find that person.
Right.
So if you are that person, call us so we can get as geeky with you as you'd like.
And you can become a loan officer.
All right, so look, what about that lock department president, the secondary market presentation last week?
That was big.
Dude, big and annoying, but I'll let you make the announcement and then I'll talk about why I was annoyed.
So, just in summary, we are now able to lock a rate. Speaking of how the rates are so good right now, let's say that you want to take advantage of these low rates, but you haven't found the house yet, or you want to take advantage of these low rates, but your lease is not done for another 30 days or 60 days,
Right.
well, we can lock the rate for up to 180 days. So if you like the rate right now, we can lock we can lock your interest rate so it doesn't move with the market up to 180 days, which is, I mean, as far as I'm concerned, you've been around way, way more than I have because you're old, but that's unheard of. I mean, I've heard of a 60-day lock, of a 90-day lock, but 180-day lock.
Yeah, and you know, you refer to it as old, but it sounds like what you're asking for. It sounds like what you're asking for is some of my wisdom. So allow me to share that with you. So I mean, you should never need to lock a loan for 180 days. But
Sure.
The exciting thing about this is that, and you failed to mention something I think is the most exciting part. You don't need a property for this.
Sorry,
and your phone keeps ringing.
Actually, clients calling me.
So so you could lock the rate without having
Yeah,
the property
without having the
identified.
property. That's
Okay.
right.
Furthermore, if you lock a rate on one property and the deal falls apart, home bad inspection,
It doesn't
you can
matter.
transfer the lock to somebody else. So not only are rates really good right now, but we could really secure people.
Yeah, and there's a way that we can manipulate it in a way that if the rates really, really improve, there's a way for us to slow it down.
Yeah, we could still renegotiate the rate lock. We'll call
So it's just exciting, man. That brings a lot of opportunities to people that want to take advantage of the rate today, and that security that it brings too.
Right.
You know, to not have to be looking at the rates
Absolutely.
and with the fear. I mean, you talked about quantitative easing, what the Fed has been doing, which was the opposite. Quantitative tightening have made the rates go up. So,
how many of you had a spelling bee word, quantitative tightening? Either of them growing up? Probably none. Just whatever.
Try it on your third language.
Yeah. Yeah, that's true. That's true. So, all right. So, look, rates are good. We have a 101% conventional program. That's awesome. We got DACA financing. We could lock rates up to 180 days without a property, which is phenomenal. We only had one question. People, send us questions. Your questions have been sucking. We need more questions so we can answer it. But
I think we answer everything. That's fine. So good.
But we want more. But you got a question about 15 versus 30.
So I have a client under contract, and he heard, as most clients do when they're under contract, from like a cousin or, you know, a very, very
knowledgeable, you know, whatever,
yeah.
plumber. I'm not picking on plumbers. Don't get mad at me.
Plumbers, I do loans for plumbers. What's better?
Right.
15-year fix or a 30-year fix?
Sure.
And you know, the problem with the question is how it's, you know, it's not what's best for me or what are the
There's no
difference.
context.
Just period.
Right.
What's better? A 15-year fix versus a 30-year fix. One is always better than the other. And as we often say here, that's almost never the case.
Right.
It's never, look, this is always the situation. So what I did, and I know this is what we do with all of our clients, is we don't just give you the answer, we present it to you.
Yeah, let's
I
run
put
the
them
numbers.
together. I put together the 15-year fix and the 30-year fix, and this is what I found in this case. For his particular rate, it was going to be about 0.5% lower.
Which is normal.
Which is the norm. And the payment itself was going to be about 40% higher.
Yes.
On the 15-year fix.
Yes.
Now, that's all well, right? You save money, you save 15 years, you save on the rate, and you know, you have to put a little bit more money. Your cash flow is not as good, but you're going to pay this property in less time. Well, what I presented to him, and this is for his particular situation, right, was that if he were to stick with that 30-year fix, which requires a lower mortgage payment every month, but makes the payments as if it was a 15-year fix, he will be done paying this property in about 17 years.
You know, it's funny, man. So Danielle and I refied back when rates were where they should be, and I was dropping mortgage insurance and I was dropping my rate quite a bit. So
Sure.
I was saving a lot of money. In fact, I was saving so much money that I could have refinanced into a new 15-year mortgage, and the payment would have been the same as what I was currently paying on a 30. Right?
Like you doing?
Beautiful situation. I wanted to. Danielle kind of steered us, pushed us. Yes, steer is the right answer, I learned. Towards the 30. And this was her thing. She said, Scott, we're both commissioned. I want to have the flexibility as the kids are getting older. I got colleges coming up, whatever. I want to have the flexibility of being able to save. In our case, it was like $500 a month.
Sure.
When we want to. So for cash flow flexibility reasons, I went with a 30-year mortgage, and again, I try to make that 15-year payment. I make it just about every month.
And again,
I did not make it, by the way, when Hurricane Irma hit. All of a sudden, Danielle was very wise.
Right.
Because my income that month was zero, so having that flexibility was helpful.
And you know, in that case, it was an extra 2 years of payment.
Right.
And having that peace of mind, if you will, or having the not having the necessity of coming up with 40% more, sometimes makes sense to take that and just pay that mortgage for an extra 2 years.
See, but here's where we gotta, and this is where the art of what we do comes into it, because now we gotta speak to the person individually. Okay,
Correct.
How are they with money? Look, a lot of people suck with money, and they don't teach money. They should. They don't teach money, and people suck with money. Not surprising, but if somebody's going to get it, if we're talking about bumping the payment from $1,500 a month to $2,000 a month,
right.
There's an awful lot of people that if they get a $1,500 bill, they're not going to pay a penny more than that. And the other $500 is just going to float away, and they're just not really going to have a smart use of the money.
Sure.
If that's the case, the forced discipline of a 15-year mortgage can make sense. So whereas it starts with just let's crunch numbers, let's look at the math of it. Now we start looking, does a person have a movement in their income? What is their spending habits? Are they good at saving money? All of these other factors, and this is why there is no answer, because now we're getting super granular. And it gets difficult. Very often, we're sitting down with a couple, and one member of the couple, either the husband or the wife, is really good with money, and maybe the other person's not that good with money. So now we got to go deeper into who's handling the finances here,
and
it's not always the person better with money.
And you know, to add another layer to that, sometimes it's not just about being good or bad with money, but you know, in your case with Danielle, is the emotional part.
100%.
You know,
what we call the livability factor.
The livability factor, right? Do you feel more comfortable one way or another, regardless of what the numbers you're looking at? And that's why we can have two people looking at the exact same numbers and feeling very strongly about
different answers.
The different answers.
Yep.
With the same budget, same principles, same everything.
And so look. You know, and this is why we have strategy sessions. We do what we do with our clients, and this is why hopefully, if you're watching, you understand that calling an 800 number and saying yes, you're good up to 300 grand, go shopping, is just, I mean, the tip of the iceberg is an exaggeration. Like it's a sliver off the tip of the iceberg.
And look, I pride myself to say that if you ask my clients why they are in the type of loans they're in, they will tell you an answer. They will actually give you an answer. They won't just say, well, Ed told me.
Yeah, or isn't that what people get?
Or that's the only thing I qualified for.
And even within, you know, and again, like we're talking now, so now we could take this same concept, right? And we could talk about this all day. It's a great conversation. Now let's talk interest rate. Do you, you know, so now we could have the same level of conversation with the comparison between closing costs and interest rate, because those two work in opposite with one another. So it's so much more than somebody gets an FHA 30-year fixed. How do we structure the loan, the closing cost, the interest rate?
Well, going back to the down payment assistance.
Yeah.
Is it worth for me to get a down payment assistance program, getting to that, pay a little bit more in the rate, or not?
Yeah.
It depends on the
situation. It depends on so many things.
Now, if you don't have the down payment, that's an easy answer.
Yes, the answer is yes.
If you have the down payment, sometimes it does, sometimes it doesn't.
Listen, when I bought my house, FHA 3.5% down. In my case, I had money for more down payment, but I was planning on doing a major rehab, and I was afraid of tying up my capital.
Sure.
So emotionally for me, my fear was, and it didn't pan out this, my fear was I allocate X number of dollars for repairs. We start peeling back the layers of the onion, and we find something we didn't expect, and I don't have the money to pay for it. That was a fear of mine. As a result of that, I paid mortgage insurance for 2 years before I refined.
And there's a lot of people that are the complete exact opposite. 100%. They go to you and they say, I want my mortgage payments to be low. Make it happen.
Yeah. And there's no right or wrong with any of it. So again, it's all about really getting inside people's heads in such a way that we understand their philosophy about money.
Right.
And sometimes marriage counselor hat goes on and reconciling that between two people, because I deal with that all the time, and I know you do as well.
And that's why showing the numbers is so important.
It has to be.
So anyways, the summary is, we have the 101% financing with no mortgage insurance. We also have 100% financing for FHA loans as well. The rates haven't been better, you know, in the past 13 months, so it's amazing. We are now financing for DACA, and we can do up to 180 they lock.
Without a property. And
it doesn't get better than
if
that,
somebody
guys.
wants, and get mortgages from everyone, if somebody wants an actual proper analysis of programs and options and qualifying and whatnot, give us a call. We're here to help.
And this opens the door to say, guys, if you're planning on buying a property within 6 months, if you're planning to buy a property within 12 months, it's worth talking to us right now. Not wait until you have to move out of that lease.
Absolutely.
Anyways,
that's what we got, man. No, that's it. I gotta get going, bro.
All right, guys.
All right,
We'll
take
see you
care.
next week.
See you next time.